Welcome everyone to today's Explainer. Whether you're a seasoned chartered accountant, a CA student deep in your studies, a tax professional, or a business owner just trying to stay ahead of the curve, you are in the right place. Today, we're diving into a really crucial provision of the newly enacted Income Tax Act 2025. Specifically, we're looking at Section 266, which is all about self-assessment tax. We're going to decode the legal text, figure out the new transition rules together, and walk through the exact practical compliance steps you need to take.
But before we get bogged down in the heavy legal text, let me throw a very real practical scenario your way. It's something every single accountant or CA faces when we hit the peak of tax filing season. Here it is. Can you successfully file your client's return without fully settling their tax dues first? Like what actually happens if there's a shortfall between the tax paid and the tax computed on the return? Well, the answer lies right in the mechanics of self-assessment. It's this fundamental obligation that basically acts as the final gatekeeper before a return is officially accepted.
So, here's our quick roadmap for today's session. We'll start with an introduction to Section 266, break down the law itself, look at a practical transition example, cover essential compliance requirements, point out some common mistakes to avoid, and wrap up with a summary of the key takeaways. Let's jump right in.
All right, kicking things off with Section 1, an introduction to Section 266. Now, under the new Income Tax Act 2025, the core underlying obligation to pay your income tax hasn't really changed at all. The entire framework, whether it's through TDS, TCS, advanced tax, or self-assessment tax, is totally preserved. Section 216 is simply the specific legal mandate that requires an SSC to clear any pending tax along with applicable interest and fees absolutely before furnishing their return of income. Think about it. You calculate your total liability, you deduct the advanced tax you've already paid, subtract any TDS or TCS, and whatever's left over, that's your self-assessment tax. Section 216 is the rule saying that balance must be zeroed out before you even think about hitting submit.
Now, here is where we see a massive, absolute game-changer of a paradigm shift. Under the old 1961 Act, we all relied heavily on the concept of an assessment year, right? The year following the previous year where the income was actually earned. Well, the new 2025 Act completely throws that term out the window. Gone. Instead, we have a unified tax year. This means the income you earn in a tax year is assessed in relation to that exact same tax year. It's so much simpler, and Section 266 operates entirely on this new tax year terminology.
Okay, moving right along to Section 2, breaking down the law. Let's see how this actually works mechanically.
So, when exactly does Section 266 get triggered? The law is very strict here. This self-assessment obligation applies anytime an SSE has to furnish a return under 4 specific sections of the new 2025 Act. First up, Section 263, which covers your standard, regular returns. Second is Section 268, which is when you're filing in response to an inquiry notice from the assessing officer. Third, we have Section 280, dealing with reassessment or income escaping assessment. And finally, Section 294, which governs updated returns. Bottom line, if you're filing under any of these, Section 266 dictates that your tax, interest, and fees are paid up front. Period.
Let's look at how we actually do this chronologically, almost like we're building a tax computation sheet together. Step 1. Compute the total tax payable on the total income for the tax year. Step 2. Deduct the taxes you've already paid. That's your advanced tax, your TDS, TCS, and any brought forward MAT or AMT credits. Step 3 is where people trip up. Following the new Income Tax Rules 2026, you've got to calculate and add any interest and fees. This includes fees for delayed filing or interest for deferring advanced tax. You add all that up and boom, that aggregate is your final self-assessment tax liability.
Let's move to Section 3. It's time to take this from legal theory to a practical taxation example.
This is especially crucial for the tricky transition period we're in. Navigating the jump between the old 1961 Act and the new 2025 Act requires absolute laser-like precision. Let's say you're paying self-assessment tax in June 2026. Because that specific payment relates to income earned back in financial year 2025-26, it's still governed by the old Act. So on the portal, you have to select Assessment Year 26-27. But if you're paying advance tax on income being earned during April 2026 to March 2027, that falls under the new Act. For those challans, you select tax year 2026-27. Remember the golden rule here, the applicable law is determined by the year the income was earned, not the day you click pay.
With that transition logic in mind, let's jump into Section 4, Essential Compliance Requirements.
Drawing directly from the department's latest transition guidance notes and FAQs, here are the non-negotiable compliance steps you need to take. Number 1, you've got to maintain a crystal clear demarcation in your books between FY 25-26 and FY 26-27. Number 2, like we just talked about, ensure every single challan reflects the correct terminology. Assessment year for the old stuff, tax year for the new. Number 3, you'll actually need to reconcile Form 26AS separately for each framework. And lastly, the e-filing portal now has a dual system toggle. You have to actively tell the portal if you're filing under the old assessment year or the new tax year system, so it can route you to the right forms.
All right, let's head into Section 5 and talk about common mistakes to avoid. Because knowing the law is great, but knowing where everyone else messes up is what makes you a true expert.
So let me tell you, muscle memory is going to be your biggest enemy here. Practitioners are going to log into the portal and blindly look for assessment year out of sheer habit, leading to massive challan mismatches. Don't fall for it. Consciously look for tax year for any income earned from April 2026 onwards. The second huge error is failing to accurately compute interest under Section 425 of the new Act. If you remember the old Section 234C, Section 425 is its new equivalent, levying a 1% or 3% interest for deferring advanced tax installments. Section 266 demands this is calculated and paid before you file. A simple miscalculation here will render your entire return defective, so double-check those numbers.
Okay, let's bring it all home with Section 6, our summary and key takeaways. To quickly wrap up everything we've covered today, first, Section 266 is the new legal mandate for self-assessment under the 2025 Act, entirely replacing the old Section 100A. Second, say goodbye to assessment year. It's been replaced by the much simpler tax year, which aligns with the financial year. Third, the golden rule hasn't changed. All tax, interest, and late fees must be paid in full before you furnish your return. And fourth, make sure you're comfortable with the dual filing interface on the portal during this transition period to avoid any routing issues. As we step into this brand new era of the tax year, I'll leave you with this question. Are your compliance systems truly ready for the shift, or are you still kind of stuck in that assessment year mindset? Thank you for watching. Please like, subscribe, and share. This explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational explainer.